The Federal Reserve issued a warning signal that caused a decline in the stock market. Wall Street is now evaluating recession risks. This morning, the U.S. Bureau of Labor Statistics released a new report on wholesale prices and weekly jobless claims. The latest data shows that U.S. March PPI increased by 2.7% YoY, lower than the estimated increase of 3% and down from the previous month's 4.6% increase. The increase has been continuously decreasing for 8 months. In addition, U.S. March PPI decreased by 0.5% MOM, hitting a new low since April 2020, and lower than the estimated 0% with the previous month's decline of 0.1%. Also, the number of first-time jobless claims in the U.S. last week was 239,000, slightly higher than the estimated 235,000 but lower than the previous week's 228,000. Though these data may not seem significant, they're important for the market. Combined with the low CPI, it's leading to an increase in expectations. Traders need to be careful not to let the expectation of the Fed lowering interest rates push the U.S. stock market higher. The Wall Street Journal reporter, Nick Timiraos, who is seen as the voice of the Fed, has warned that even though the possibility of the U.S. falling into an economic recession is high later this year, stubborn inflation and a tight labor market are forcing Fed officials to signal that they may continue raising interest rates in May. In the banking industry, Goldman Sachs has been a hawkish investment bank on the Fed's rate expectations in the past few months. Its opinion quickly became the consensus of many people within 24 hours. Most senior officials believe that the Fed needs further tightening measures. Overall, there are 2 types of interest rate expectations in the market. One is the trading expectation, and the other is the survey expectation of economists. From historical experience, the survey expectation may be more meaningful than the trading expectation, with an accuracy rate of over 90%. Looking at the European market, as the global interest rate hike is coming to an end, even the European Central Bank, which started raising rates the latest, seems to be slowing down. Media reports indicate that European Central Bank policy makers' views on raising interest rates by 25 basis points in May are nearing consensus, but other options are still on the table. To sum up, the market is still uncertain. While the Fed may continue raising interest rates in May, it may not lower interest rates this year. The European Central Bank may also choose to take a more cautious approach. It's important to stay alert and make informed decisions based on all available information.